War-driven energy shock on one side, and AI boom on the other. The market's pulling in two directions at once, and the signals just aren't lining up. In this episode, portfolio manager Steven Visscher explains how he's positioning Mawer's balanced portfolios through it all, where he's leaning in, where he's holding back, and why discipline beats heroics. And as usual, Steven provides a measured look at a noisy market. All right, Steven Visscher, welcome back to the podcast.
Thanks for having me, Andrew. It's great to be here today. I always look forward to our discussions.
Yeah, me too. It's great to have you back. I know I'm curious to hear what it's like sitting around the table at asset mix committee meetings these days with all that's going on in the world and the tug of war that we have going on in many different ways. But before we get to that, even though we're almost, I guess, halfway through the year here, I think it's worth taking a minute just to set the table by looking back at how 2025 unfolded, because I think it will serve us well for the rest of the discussion. So give us a quick recap of 2025 for the balanced portfolios.
When I reflect on 2025, one of the stories that seemed to stay with us through much of the year was the U.S. administration's unveiling of their new tariff regime. And, looking back, that was certainly the communication and the implementation of their tariff policies seemed pretty chaotic and disjointed. Maybe I'm putting that kindly. What it led to was a considerable amount of uncertainty in markets. So there was worries that tariffs could reignite inflation, concerns that this could be the catalyst for a severe global economic recession, worries that the U.S. may lose its status as a trusted partner, and the U.S. dollar could lose its status as a global reserve currency. So it led to considerable volatility throughout the year, both to the downside as well as the upside. The way we navigated the environment from a balance perspective was to stay fairly neutral. And by that, I mean we kept our equity allocation fairly close to our 60% target. But in doing so, we did execute what I would call a more meaningful shift out of U.S. equities and reallocated that capital to Canadian equity markets, international, and emerging markets. That decision actually proved to be quite favorable for our balanced portfolio in that each of those regions significantly outperformed the U.S. markets in 2025. Andrew, you'll also recall from a fixed income standpoint, we introduced our global credit strategy to the portfolio, and during the year, we incrementally allocated more capital to global credit as the year unfolded. In the end, this was a calendar year in which cash, bonds, and equities all posted positive returns. In fact, it was the third consecutive year in which each major asset class posted positive returns. The third consecutive year in which total returns for our core balance strategies were well above historical norms. So it was no question an environment that was quite rewarding to balanced investors, and I'm happy to share that the growth in balanced portfolios has continued here in the first 5 months of 2026.
Thanks for the refresher. I mean, just you and I both know things are moving so fast that sometimes things just from 6 months ago feel like a lifetime. So, and some of those things did not politely stay in 2025. They've carried through to this year, but some new themes have emerged as well. Has there been a single dominant theme of 2026 so far?
There's two that come to mind. Let's start with geopolitics. So obviously the conflict in Iran has created a global energy shock, a supply shock. And this has led to, again, concerns that higher energy prices could lead to a reassertion of inflation. There's been a number of central banks that had been on the path of reducing interest rates. Again, around the world, we've seen numerous central banks that have now paused and, in fact, pivoted to signal that interest rates may need to rise in order to keep inflation subdued. It isn't just short-term rates that have been impacted, but if we look again around the world, yield curves have shifted up. So whether it's a 10-year yield or a 30-year yield, we've seen these rise to levels that we haven't seen in many years, and in some cases, decades. So that backdrop of an energy shock with inflation concerns and rising interest rates certainly hasn't been a, a great backdrop for risk assets. This is not great news for bonds or equities. And so investors are really wrestling with the outcome of this conflict in Iran. But while all of that is happening from a geopolitical standpoint, we're also experiencing just this incredible, immense investment in AI. Certainly, that's a dominant theme so far this year. The amount of capital expenditures has risen continually, and it continues to be revised higher with no signs of abating. And so this is a really potentially a transformative technology that is drawing in an immense amount of capital. I think initially, if we look back at previous years, a lot of that investor enthusiasm was maybe centered around NVIDIA and Taiwan Semiconductor and a handful of the hyperscalers, but it's really now broadened to encompass a whole other host of businesses. It's not just the chip makers, but it's businesses that are providing memory and storage. There's cooling and packaging and optics and data center buildouts, power grid and electrical grid. So it's captivated a much larger group of businesses. And it's really driving positive earnings momentum across the entire global economy. Andrew, I was looking at some statistics the other day, reading about the first quarter earnings in the S&P 500. And at the time, not all 500 companies had reported, but those that had, 80% of them, more than 80% of them had exceeded earnings expectations, which is astonishing. 9 out of the 11 sectors of the economy were enjoying rising profit margins, with several sectors enjoying profit margins that were at all-time high levels. So there's this undeniable earnings momentum that is occurring, driven by this immense investment in AI.
Just before we leave AI, I do want to turn that over a little bit, because you mentioned that it's no longer just a narrow set of stocks that are dominating index returns, for example, but it is still a narrow theme that is driving things. How much of the market's resilience now depends on AI CapEx continuing? So is that concentration something that you're actively worrying about, or is it something that you weigh in your asset mix decisions?
Yeah, absolutely. I mean, when you have a single theme like that, that's really driving global earnings growth and global economic momentum, it is a risk. And the capital expenditure that we're seeing may prove to be cyclical and not as sustainable as investors may be assuming, particularly when it's unclear what the financial or monetary reward might be from that capital expenditure. So it's no question a risk, and I think it takes us back to first investing principles. So we want to make sure that the portfolio is not overly exposed to that one theme. We don't want the balanced portfolio to be overwhelmed by that one factor. We want to make sure that we've got adequate diversification, that we've built in natural contradictions in the portfolio, and ultimately we want to stay disciplined on valuation. And that's what our underlying equity teams are doing, is they're evaluating AI, but also through that valuation lens, and making sure that as companies start to appear expensive, they're continuing to trim back from those positions and reinvest into businesses that are trading at more reasonable valuations. So it's a risk, but I also, again, want to remind our viewers and listeners that the purpose isn't to eliminate and avoid risks. It's to ensure that we're being adequately compensated for assuming those risks. And so the truth is, like, our equity managers, our teams are finding incredible businesses within this AI complex, businesses that have undeniable competitive advantages, clear pricing power, and businesses that are in the throes of a real step up in their earnings and revenue growth. And these are the exact type of businesses that we'd like to own. We just have to make sure we do it in a balanced and measured way. So it's a risk, but it's also an opportunity.
Okay, so I mean, seems like a genuine tug of war then. Let's move to the practical side of things. How does that, all of what you just said, how does that actually show up in the portfolio? In other words, how are you positioning balanced portfolios And what's changed in 2026 relative to what you just mentioned about 2025?
It really is a tug of war, and there's multiple factors at play. If we just looked at earnings and the momentum that we're seeing, that might signal that you want to take on more risk in the portfolio. But again, going back to the geopolitical situation, the inflation and interest rate environment, we do think that warrants some caution. And so naturally, unsurprisingly, it brings us back to more of a neutral stance, keeping that equity not far from our 60% target. When we look at some of the other factors, valuation as an example, again, we feel that this is an environment when it's giving us a little bit of a mixed signal. We certainly wouldn't characterize current valuations as being incredibly attractive and a reason why you'd want to layer on additional risk in the portfolio. Again, our equity teams are staying disciplined on that and managing that risk as best they could. But it's like, kind of look at it. It's not a green light. It's not a red light. It's a yellow light. So it's not a reason we'd want to stray too far from neutral. Andrew, you and I were talking not long ago about investor psychology and sentiment. That's another factor that we consider from an asset mix standpoint. And our view, our feeling is that there's a higher level of risk taking right now. There's a certain sense of complacency among investors. Indications of that might be, I saw a study where they bucketed companies into those that were profitable, so companies that were earning positive earnings and positive cash flow, and comparing that to companies that were unprofitable. These are businesses that maybe have a business model that's maybe in the early stages of execution, could be excessive levels of debt, but for whatever reason, they aren't turning a profit yet. Yet when we look at the stock returns in 2025 of those two buckets, we're seeing that those unprofitable companies have generated much higher returns than the more higher quality blue chip companies that comprise our portfolios. So that's a sign of, again, maybe some excessive risk taking. Even in the fixed income world, we're seeing credit spreads that have not excessively ballooned to reflect some of these risks. They're continuing to be relatively narrow, and our fixed income team is not finding that this is an environment where they want to take on excessive risk on the credit side. So, all in all, when we look at earnings, when we look at interest rates, valuations, investor psychology, we've arrived back at a stance that, again, is fairly neutral. I spoke earlier about our prior decision to reduce U.S. equities and have a greater emphasis in international and emerging markets. We've allowed that to continue. So that's how the portfolio is currently positioned, with a much larger bias or weight to equities outside of the US. But other than that, yeah, like I said, we're staying fairly close to neutral just to reflect the the mixed signals that we're getting from some of those factors.
Maybe I'll just kind of keep score on some of those, that framework of signals that you mentioned for everybody. Rates probably a yellow light, as you mentioned. Earnings much more closer to green, it looks like, at least generally speaking. Valuations, as you said, is kind of somewhere in the middle. Then that investor psychology piece really hinting at caution. So, as you said, mixed overall, really no clean green light anywhere. One thing that I wanted to ask you about just before we wrap this segment is, and we can keep it brief because we had Brian on just last month digging into credit. But earlier this year, the read was that cracks in private credit, which we've all seen the headlines about, and they've dominated from, at various points in time, but they hadn't really unsettled markets. But from where you sit today, is that more of a warning light now, or is this perhaps a dislocation unfolding that you'd actually want to lean into from an asset mix perspective?
Yeah, no, interesting observation. We have seen cracks in private credit. There's been a number of larger corporate bankruptcies and defaults that have affected private credit bondholders. Some of the latest news is some of the larger private credit managers are now facing client redemption requests that they're not able to meet with current assets, and it's created what we call gating, or creating a queue that those investors now have to patiently wait to extract their capital from the asset class. But we haven't seen those cracks spill over in a material way into public fixed income markets where Brian and the rest of our fixed income team is operating. So as I said, we just haven't seen spreads widen materially to maybe reflect some of those risks. And so the current positioning of the global credit strategy continues to be relatively conservative. The duration is fairly low, and the percentage of the portfolio that's invested in higher yield securities is relatively low as well. Now, I know Brian and his team, they're watching this every day. They're waiting for that dislocation to occur, and they're ready to, again, dynamically transform that portfolio when those opportunities arise. What I might say from a balance perspective is our playbook is ready as well. We've been again gradually, incrementally building up our exposure to global credit, and we'll likely continue to do that here as 2026 unfolds. But if we get a dislocation, if we start to see these opportunities really present themselves, uh, we're ready to allocate capital in a larger and faster way to the asset class. So it's um, it's a potentially uh, exciting opportunity. We're happy to see some of these cracks in private credit. Again, there's just been so much complacency around the asset class. But if we do get those cracks, if we do get those dislocations that spill over into public markets, it's an incredible opportunity for our balanced portfolio.
Really calls back to a phrase that we've used a lot around the firm, which is crocodile investing. Just being ready, doing the work, and waiting for that opportunity. Typically, when a valuation change has happened in the market, and gives us a great entry point. Okay, so we've moved through 2025. We've hit the year so far in 2026 with the external forces as well as the internal moves that you've made in response to those. Maybe before we close, were there any final thoughts that you wanted to share?
First off, it's such a privilege to have this forum, Andrew, to be able to speak directly to our balanced investors and unit holders. And I speak with clients frequently, and it's so encouraging to hear the positive feedback that we've received from clients. Again, the absolute returns that we've been able to deliver in the last number of years are making a difference in people's lives. I've got stories of clients that have been able to retire earlier than they had anticipated because of the absolute growth in their portfolio. Families that have been able to share more generously with their children and grandchildren because of the growth in their portfolio. Andrew, I know you work with a number of foundations and charities. You know firsthand how the returns that we've been able to deliver is allowing those organizations to make a meaningful impact on their communities. That's what makes us tick. I can speak, I'm sure, for you, Andrew, and everybody at Mawer. This is what we're in this industry for, is to do our part and help clients achieve those objectives. However, we're very cognizant that the returns that we've delivered in the last number of years, while have been great from an absolute standpoint, we are hearing from clients, and deservedly so, that our results have failed to keep up with our benchmarks. And that's not specific to our balance strategies. That's something that we're experiencing across most of our equity mandates. Andrew, we could probably spend an hour discussing, revisiting why, reviewing the makeup of some of the benchmarks, how they become incredibly concentrated in a narrow group of companies, maybe philosophically debate whether they even represent a good alternative that a prudent investor would follow. I don't want to get into all of the reasons for that underperformance, but what I thought I'd leave unit holders and our investors with is maybe just a refresher on the characteristics of our balanced portfolio relative to the benchmark. As an example, if we look at the return on equity of the companies that we own in the portfolio, it's greater than that of our benchmark. The return on invested capital is greater than our benchmark. The businesses that we own have less debt and leverage than the companies in our benchmark. Looking at something like earnings growth over, say, the last 3 years, our collection of portfolios has grown earnings at a materially faster rate than the benchmark. These are all hallmarks or evidence of a higher quality portfolio. It's frustrating that we're not being rewarded for building that type of portfolio in this environment. But I think it's important to note that we're adhering to our discipline, adhering to our philosophy, and are constructing portfolios that bear these characteristics. On the valuation side, what one might expect that building a higher quality portfolio would mean you're paying a premium. That's actually not the case. We've been able to build that portfolio, yet still have valuations that are slightly less than the index. And if we look at history, if we look at Mawer's 50-odd year history, portfolios with those characteristics have not only delivered strong absolute returns, but they have added value over their benchmark. Not in every environment, certainly not in this environment, but we do want to reassure our clients and our unit holders that we feel we've constructed the right type of portfolio to set them up for success, not just to continue to meet their absolute goals, but we feel that in time, we'll see that performance on a relative basis improve.
I think that's a great place to wrap things up, Steven. And the through line that I've noticed as I've listened to you is that, number one, these mixed signals out there, they really aren't a malfunction. They're kind of the normal weather of markets, but the edge isn't in forecasting which way the wind blows next. It's in building something that, doesn't get blown around when it finally does change. So thank you for joining us, Steven. Always appreciate you sharing the view from your seat, and I'm looking forward to the next time that we get to chat.
Thank you so much for having me, Andrew, and thank you to all of our readers and listeners.